Ladies and gentlemen, my name is Mohammed Al-Yusuf, and alongside my classmates Shayma, Geeta, and Lazat, we're going to discuss the net working capital of Qatar National Cement Company, QNCC. We will first introduce the concept of net working capital and give an overview of the company. We will then start our analysis, touching upon cash management, inventory management, accounts payable management, accounts receivable management, and the potential risks that QNCC might face. We will also suggest some financial strategies to enhance the working capital management of the company. I will now hand over to Shayma, who will start with an introduction.
Working capital, also known as net working capital.
Thank you very much, Shayma. QNCC enjoys a positive net working capital situation, which is desirable for all operating companies as it reduces the risk of bankruptcy. It also shows that the company is able to explore further opportunities, business opportunities to grow, and it is more appealing to banks and financial institutions from a lending perspective. Having said that, there are some disadvantages of having positive net working capital. It may sound that the company is not able to manage its current assets efficiently, where cash might be sitting idle and not generating income. It also may seem that the company's trade cycle depends on the suppliers and buyers, and that the company has no control over it. So there are certain factors influence the positive net working capital situation that Qatar National Cement Company enjoys. The first one is the nature of business. Manufacturing companies usually tend to have higher inventories from raw materials to finished goods, due to the fact that manufacturing process takes some time. They also tend to have high accounts receivables due to the credit terms offered to their customers. When it comes to credit terms, QNCC seems to offer its customers good credit terms, and therefore 50% of the company's sales are on credit. Whereas it seems like QNCC's suppliers do not offer such good terms to the company, and therefore most of the company's purchases are done via advanced payment. QNCC purchases raw materials from the market, and it is affected by the fluctuation of prices due to supply and demand, which eventually affects the company's costs and revenues. QNCC will not be able to charge their clients more than their competitors, and hence if the raw materials prices increase, QNCC is able to increase the prices slightly, but then eventually it will start affecting the demand of QNCC's products, and hence a good management of costs and revenues is required. When it comes to strategies for working capital management, we will discuss 5 different aspects of the strategies. We will first talk about the cash management and then move on to inventory management, accounts payables management, accounts receivable management, and then risks. Starting with cash management, we've analyzed the company's financials over the past 5 years, and we saw that the company in 2018 and 2019 had negative cash flows. However, they remained having positive operating cash flows over the 5 years analyzed. There are certain factors that influence the cash and cash management of Qatar National Cement Company, starting with banking and the recent interest rate hikes, where we expect that the current loans that QNCC has, they'll have to pay more interest on these loans because most of loans provided by companies are floating rates, and therefore it is now more expensive for QNCC to maintain. A second point is inflation. Due to the recent Russian and Ukrainian war, we have seen inflation, global inflation around the world. Central banks are trying to tackle the inflation by raising interest rates. But we need to keep in mind that QNCC's raw materials are also increasing in prices, and that will affect the company's cash position. The company is expected to match the cash flows, inflows and outflows, but at this point in time, it seems like they are not. It seems like they have to pay their suppliers in advance, and then the buyers will pay on credit. And therefore there is a mismatch between the inflows and outflows. It also seems that the company maintains a huge amount of cash, idle cash, not generating income. And that is also one of the issues that needs to be managed properly. We suggest the following when it comes to cash management. The company needs to properly manage the interest rate exposure that they have given the current interest rates environment. The company needs to be aware of the different banking products and different interest rates charged on these banking products. For example, rather than getting an overdraft to enhance the trade cycle or to fund the raw materials, the company might opt to get a supply chain finance, which is cheaper in price, and save on the interest rate expense. Another suggestion is hedging. When it comes to raw material prices, we recommend that QNCC utilizes their banking partners to provide some hedging on the commodities or on the raw materials that they require. Given the current increase in prices, hedging will ensure that QNCC has a specific fixed price for the raw materials, and therefore they are able to charge their clients without a further increase in prices. The third option, or the third suggestion, is managing the trade cycle efficiently. Having said that, the company has to pay their suppliers in advance, it is recommended that they negotiate better credit terms with their suppliers and utilizing the supply chain finance product that the banks are able to offer. We also recommend reducing the inventory overstocking. There are certain systems and ERPs in place that the company is able to invest in that manages the inventory and stock more efficiently. And this is a recommendation to reduce the amount of inventory held in the company, which then eventually reduces the warehousing expenses and the shelving expenses of the company.
What is inventory and inventory management? Inventory management may become difficult.
And now let's move to how the company manages its accounts payable. So first of all, account payable represents the short-term money owed by a company, and it is one of the primary considerations when managing working capital. Companies work hard to equalize payables with receivables in order to sustain the highest level of cash the company owns. So, by keeping the working capital requirements to a minimum while satisfying operational expectations, can yield to a boost in the return on investments and free up cash flow for further growth and investments. So this is a new approach that has been never more valuable following the devastating events of the COVID-19 pandemic. To have an idea about the origin and the distribution of the accounts payable, we examined the accounts payables of the company as follows. The 30 million Qatar Riyal increase between the 2018 and 2019 has been due to the expenses related to the purchase of pipeline, metering facilities, and further costs related to the supply of natural gas from Plant 4 to Al Bab. So, finally, the accounts payables were mainly due to the procurement of necessary resources to achieve the day-to-day activities within this time framework. In order to meet the needs of its daily operations, the company has decided to enter into a partnership agreement with Qatar Petroleum and Qatar General Electricity and Water to purchase a minimum amount of energy to be consumed in the cement plants, in the 5 cement plants. So this is recorded on the account and other accounts payable in the exhibits on the left under the section of accruals against energy suppliers. For more detailed breakdown of these amounts, the exhibits below shows the distribution of these amounts for each of the government's facilities agreed to partner with. In 2017, the company was prosecuted by the Ministry of Municipality and Environment of the State of Qatar for mining raw materials beyond allocated zones over a period of 7 years, from 2018 to 2011. The company was penalized by the court and settled an amount around 34 million Riyal Qatari. This will be split into 5 equally sized annual payments effective June 2021, as shown on the related expenses and amicable legal claim in the exhibit on the left. And the company has paid a fine of 2 million Riyal Qatari of late payments of the legal claims in 2019, meaning that it does not manage its accounts payable properly. The company has a sound dividend policy and a 30 years dividend payment history. In 2019, the board member proposed a 30% cash dividend reaching approximately 196 million Riyal Qatari. For the year of 2020, the company paid the highest amount of dividends since its launch. The board committee agreed to pay a cash dividend of 50% of the paid capital. The company has agreed to pay 2.5% of its profit to serve social, cultural, and charitable purposes. The amount will be taken from the retained earnings of the company at the end of the fiscal year. Several strategies are being implemented to reduce working capital, including tactical accounts payable schemes to help the companies optimize their working capital and have more cash to meet future needs. From the analysis of the accounts payable management, it appears that the company sometimes pays penalties for delayed payments. Qatar Cement should formulate a plan to make cash more available on its balance sheet accounts. Proper accounts payable management is critical in assisting to generate the extra cash flow necessary to leverage operations, finance business development, and deliver superior services, minimize expenses, and capitalize on emerging opportunities for investments. So, for that, the company should centralize the treatment and the recording of the accounts payable, meaning it has to create a collaborative work environment for handling and recording its payables. This help ensures adherence to consistent norms and methods among all the employees within the company. And also, it will allow for easy measurement of employee performance in comparison to the success metrics and also with those of the competitors. On the other hand, it allows to complete a job in a faster and more efficient way, and it is a cost minimizing procedure. Second, the company must adopt an electronic payment system. Many companies across similar industries are adopting this time-saving strategy for registering the purchase order, inspecting the goods received, approving the invoices and the bills, and then making sure to settle the duties on the scheduled time. Third, supplier portal. As Qatar Cement partners with government entities, it must ensure that it meets the annual remittance deadline, avoid penalties, and optimizes the accounts payable process in general. Fourth, create a transparency around billing entries to boost the liquidity. Qatar Cement can negotiate early payment discounts with its suppliers. It is highly recommended to take advantage of these opportunities to save extra money. In addition, accounts payable balances should be uploaded and updated frequently so that they are not any out-to-date obligation and to avoid delayed payments. On the other hand, a good payables management scheme is concerned not only with automating payments, but also with building healthy relationships with suppliers and with the working environment in general. It is more than just paying the dues. It is also a question of functioning with a professional manner. The more comfortable the suppliers feel about collaborating with the company, the more opportunities there will be.
Hello everyone, my name is Lazad, and now moving to the account receivable management. One of the measures to sustain in competition is to provide credit to the customers, and the receivables of any company, if managed effectively, increase the current assets of the company, which lead to the increase in the working capital of the company. On the other hand, if the company has the excess of the receivables, it increases the cost by blockage of funds of the company. So, as we mentioned earlier, the report is conducted based on the Qatar National Cement Company. And so the account receivable management in this company and in general is the process of ensuring that the customers pay their debts on time. And so this helps businesses to prevent working capital from running out of any given time. It also prevents customers from having late payments or not paying the pending payment. To analyze the account receivable management for the company, we use the key metrics such as the account receivable and also the account receivable turnover and the day sales outstanding. In analyzing the account receivable turnover ratio, we can see that in 2017, the Qatar National Cement Company's account receivable turnover ratio is higher comparing to the other years, which was 4.33 times. And in 2018, the account receivable turnover ratio decreased, which is 2.94 times. So similarly, it kept decreasing next years as well, starting from 2018 to 2020. The drop was from 2.94 times to 2.1. However, there is a change of increase in account receivable turnover in 2021, which is 2.51 times. Though comparing between 2017 and 2021, their account receivable ratio is still lower than it was back in the years. In 2021, Qatar Cement Company's account receivable turnover ratio is higher than 2020. That means in this year the company's collection process is more efficient than 2020, and they have a high proportion of quality customers that pay their debt quickly. Though in 2018 their account receivable turnover ratio is decreased by much more. It indicates that in this year their collection process is inefficient. They maintained an inadequate credit policy, or their customers are not financially viable or credit worthy. However, we can see that they managed their collection process in 2021, by which the account receivable has increased. Moving to this slide, the total of 158 million Qatar money is receivable from the four major clients, which shows 48% of the total account receivables as of December 31, 2021. And in the previous years, in 2020, 101 million Qatar money is receivable from the three major clients, which shows 32%. So we can see that it got increased in 2021. So the suggestions would be that that the company is required to maintain a balance between the liquidity and the profitability while conducting its day-to-day operations. Um, Liquidity is a prerequisite condition to ensure that the firm is able to meet its short-term obligations, and its continued flow can also be guaranteed from the profitable revenue. So the company can also increase their working capital ratio more than one to have the sufficient current assets to pay off their current liabilities. So the managers, they can create the profits for their companies by handling the cash conversion cycle correctly and by keeping the account receivable at an optimal level during these periods. Now moving to the risk management. The company monitors and manages the financial risks related to its business and operations. The company has various financial assets such as the accounts and the other receivables, and the financial assets and the fair value through other comprehensive income, and the cash and cash equivalents which arise directly from the operations. So the company seeks to minimize the effects of these risks by diversifying the resource of its capital. Um, it maintains timely reports about the risk management functions and monitors the risk and the policies implemented to mitigate the risk exposure. So the company has the following risks, such as the liquidity risk, capital risk, market risk, operational risk, and the credit risk. So the liquidity risk is the risk that the company will encounter difficulties in raising funds to meet the commitments associated with the financial instruments. The company manages liquidity by maintaining adequate reserves, banking facilities, and by continually monitoring cash flows and matching the maturity profiles of the financial assets and the liabilities. So the company can approach in managing the liquidity risk is to ensure that it will always have the sufficient liquidity to meet its liabilities when it's due under both the normal and the stress conditions, and without incurring unacceptable losses or even risking the damage to the company's reputation. So the typically company ensures that it has the sufficient cash on demand to meet the expected operational expenses, including the servicing of the financial obligations, um, and also the other circumstances that cannot be reasonably predicted, such as the natural disasters. The credit risk is the risk of the financial loss to the company if the customer or the counterparty to a financial instrument fails to meet its contractual obligations. The financial instruments that potentially expose the concentration of the credit risk include cash in the bank's account and the other receivables. So in order to minimize the credit risk, the company they should keep the credit policy in place, and the exposure to the credit risk needs to be monitored on the ongoing basis. The company needs to manage its credit risk by obtaining the bank guarantees from the customers. Also, further credit evaluations needs to be performed on all the customers, including the credit, and are needs to be approved by the management. And also the account receivable are stated at the original invoice amount, less provision for any uncollectible amounts as well. The Qatar company's policy is to maintain a strong capital base so as to maintain investor, creditor, and the market confidence, and to sustain future development of the business. So regularly the company reviews its capital structure and considers the cost of capital and the risk associated with it. And to manage its capital, they need to ensure that it will be able to support its operations while also maximizing the return to shareholders. through the optimization of the debt and the equity balance. So as part of this review, the management, they need to consider the cost of the capital and the risk associated with each class of the capital. Market risk is the risk that changes in the market prices, such as foreign exchange rates, interest rates, equity prices, which will affect the company's income or the value of its holding of the financial instruments. So the goal of the market risk management is to actually control and manage the market risk exposures within the acceptable parameters. So the the primary market risk would be the interest rate risk, and the company has maintained in financial instruments which are subject to the interest rate risk and which may potentially result in changes in the contractually determined cash flows associated with it, um, or may cause repricing of such financial instruments. So the company is exposed to the financial rate risk on its interest-bearing financial assets. So for the interest rate risk, the company can apply for a fixed rate loan. So the company can also choose the interest swap to avoid the interest rate risk.
Thank you, ladies and gentlemen, for listening to us, and we will now open the floor for any questions.